In this chapter, we will introduce a series of rules related to the accessing public capital, including the rules governing the listing of securities on the Stock Exchange of Hong Kong Limited, referred to as the listing rules, the Code on Takeovers and Mergers, issued by the SFC, Securities and Futures Commission, referred to as the Takeovers Code, and the Code on Share Buybacks, referred to as the Share Buybacks Code. So what is accessing public capital? That is, a company raises funds through the public market. What are the possible ways? For example, IPO, initial public offering, that is, the company is listed on the stock exchange and issues shares to the public for the first time, or additional issuance of shares, that is, the company issues more shares to the public again, or issuing bonds or other securities to raise funds by borrowing. In order to ensure that the market is fair, orderly, and effective, the process of assessing public capital needs to comply with relevant laws and regulations. Next, we will introduce the listing rules. First of all, what is listing? Remember, listing refers to the process where the securities issued by a company, i.e., stocks or bonds, are admitted for trading on an exchange. For example, if Vitasoy is listed on the SEC, Stock Exchange of Hong Kong, it means that Vitasoy's shares can be bought on the stock exchange, which is considered as listing. Do you understand? In Hong Kong, who is in charge of listing matters? The SEC. What kind of transactions does the SEC handle? Securities transactions. Do you remember what it includes? Daily trading of stocks, bonds, as well as exchange-traded funds, structured products such as derivative warrants, bull-bear certificates, and stock options. All of these are conducted on the SEC. Does the HKEX, Hong Kong Exchanges and Clearing Limited handle listing matters? No, it's the SEC that handles it. Although HKEX is called an exchange, it is not a securities exchange, but an exchange controller. Let me ask you a question first. What would happen if the market had no rules? It would definitely be a mess, right? In order to ensure fairness, order, and efficiency in the market, there must be rules for listing. The SEC, Stock Exchange of Hong Kong, has formulated two sets of listing rules. If you list on the main board of the SEC, you must comply with the main board listing rules. If you list on the GEM of the SEC, you must comply with the GEM listing rules. The main board is mainly aimed at companies that already have a certain scale and stable profitability. Therefore, the main board market is relatively stable and less volatile, mainly attracting investors who want stable returns. In contrast to the main board is the GEM, Growth Enterprise Market, which is set up specifically for small and medium-sized enterprises, especially high-tech enterprises and high-growth enterprises. The GEM has lower requirements for the size and profitability of companies compared to the main board, but because the companies involved are smaller and grow faster, the risks are relatively higher. The GEM is a buyer bears risk market, which means you are aware of the risks. Since the investment risk is higher and the volatility is greater, the stock price fluctuates more, so it is more suitable for professional investors who can bear high risks or investors with high risk preference. These two sets of listing rules clearly state the requirements to be met when securities are listed. Whether it is at the time of applying for listing or after listing, these listing rules must be complied with. Do you understand? Are these listing rules legal requirements? No. Does violating these listing rules mean violating the law? No, so you won't go to jail, all right? Why do we need listing rules? What is the purpose of these rules? These rules are in place to ensure that companies applying for listing meet the listing qualifications. Moreover, there are procedures and timelines before, during, and after listing, which makes the process orderly and efficient. Furthermore, the process of issuing and selling securities becomes more fair and orderly. Do you understand? According to the provisions of the listing rules, Listed companies are required to provide the public and investors with material information that affects the price of listed securities, such as financial and operational information. This is to ensure fairness and equality for all shareholders. At the same time, as a director of a listed company, one should prioritize the interests of shareholders and also consider the rights of minority shareholders, okay? Unless there are special provisions, the shares of a new listed company must be offered to existing shareholders first. These are the events that the listing rules are most concerned about, okay? So, who are the people involved in the listing process? The most important one is called the issuer, which is the company preparing for listing. Directors and controlling shareholders of the issuer. Authorized representatives, who act as a bridge for communication with the exchange. Sponsors, which are the professional compliance advisor before listing. Compliance advisors, which are the professional compliance advisor after listing. And IFAs, independent financial advisor, who provides advice on mergers and acquisitions and share buybacks. And promoters and reporting accountants, these are professional support personnel. What are the responsibilities of the issuer's directors? Firstly, like any director, they must have suitable skills and be able to act with care and diligence. This is a fiduciary duty. They must comply with the Model Code for Securities Transactions by directors of listed issuers. They must comply with the issuer's own code of conduct, which is the rules set by their own company, okay? So, the difference from a general director is not very big. Remember, every board of a listed issuer must have at least 3 INs, independent non-executive directors, okay? What are INs for? As mentioned before, they are there to balance the executive directors. Among these 3 independent non-executive directors, at least one must have appropriate professional qualifications. What is considered appropriate? It refers to individuals with professional knowledge in accounting or financial management, okay? Remember, these independent non-executive directors who balance the board cannot be less than 3 in number, and they must also constitute at least 1/3 of the board of directors, okay? The independence of an independent non-executive director is crucial. So, what constitutes independence? What are the requirements? It means that the director's life, property, and wealth are not related to the company. Financially, they should not depend on the listed company, nor on its subsidiaries, parent company, or connected persons. That's what we call independence. Who are the connected persons of a listed issuer? They include its directors, chief executives, or substantial shareholders. Independent non-executive directors should not be connected with these people. They should not have familial relationships, whether it's parents, siblings, or partners. Also, they should not be financially dependent. Why is there such a requirement for independent non-executive directors not to serve as a director, partner, or principal of a professional advisor within 2 years prior to their appointment? Again, it's out of concern that these independent non-executive directors may lose their independence. So, who might compromise the independence of an independent non-executive director if they serve them? The listed issuer, the controlling company of the listed issuer, its subsidiaries, as well as controlling shareholders, chief executives, any directors, and their closely associates. Independent non-executive directors should also not have material business interests with the listed issuer, the parent company of the listed issuer, its subsidiaries, or connected persons. For example, imagine that I am an independent non-executive director in a listed company called ABC. It turns out that the major shareholder of ABC's holding company has a lot of business dealings with our company, giving us a lot of professional stock affairs to handle and frequently giving us business. In this situation, am I not very close to them? Can I still call myself independent? Obviously, I'm not independent. There is clearly a material business interest relationship. Also, the number of issued shares of the listed issuer held by the independent non-executive director should not exceed 1%. Note that if it exceeds 5% or more, it is generally not considered independent. So what if it's between 1% to 5%? You have to submit a written confirmation to the SEC, Stock Exchange of Hong Kong. If the independent non-executive director obtains securities interests of the listed company from the listed issuer or core connected persons through gifts or other financial support, they must submit written confirmation to the SEC, Stock Exchange of Hong Kong. To comply with the listing rules, every listed issuer, every listed company, must have an audit committee. Remember, all members of the audit committee are non-executive directors, and there must be at least 3 members. The majority should be independent non-executive directors. Among them, one independent non-executive director must have accounting or financial management expertise. The chairperson of this audit committee must be an independent non-executive director. In summary, this audit committee is to balance the executive directors, okay? What are the regulations for controlling shareholders in the listing rules? Firstly, who can be a controlling shareholder? A shareholder who has the right to exercise or control 30% or more of the voting shares. What does this mean? That is, the shareholding held by the shareholder gives them at least 30% of the voting rights. In this way, they can have a significant impact on decision-making at the company's shareholder meetings. In addition, if an individual or a group of people has the right to decide who can become the majority of the company's board of directors, then this individual or group will also be regarded as a controlling shareholder. Why is that? As we all know, the board of directors is responsible for managing the daily operations of the company and making important decisions. Therefore, individuals or groups that can control the members of the board of directors can actually control the operation of the company. In simple terms, a controlling shareholder is a person who owns more than 30% of the company's voting rights, or a person or group that can determine the majority of the board of directors and can have a significant impact on the operation and decision-making of the company. Do you know what an authorized representative does? They are the main communication channel between the listed issuer and the SEC, Stock Exchange of Hong Kong, okay? Every listed company must appoint 2 authorized representatives. Main board listed companies can find 2 directors, or 1 director and a company secretary to do it. GEM companies need to find executive directors or company secretaries. Any 2 people will do. Next, let's talk about the professional advisors for listed companies, i.e., listed issuers, which are divided into 3 categories: sponsors, compliance advisors, and IFAs, independent financial advisors, okay? These 3 types of people are professional advisors who provide services for listed issuers and must perform their duties impartially. They also have to comply with the listing rules and cooperate with the SEC, Stock Exchange of Hong Kong, in any investigations conducted by the SEC, okay? Alright, so what is a sponsor? A sponsor is a professional advisor who helps clients, that is, listed companies, apply for listing, understand? Before each listed company, each listed issuer goes public, they must find at least 1 sponsor. So you said at least 1, can you hire more? Yes. You can hire more than 1 sponsor. As long as the sponsor has no relationship with the listed company and is independent of the listing applicant, it's fine. And all sponsors have to be responsible for the listed company. If there are any errors in the process of the company's listing, the sponsor is responsible, understand? Remember, the job of a sponsor must be done by a licensed or registered intermediary, clear? So what type of license is needed? At least a Type 6 license is required, which is for advising on corporate finance. If the SEC, Stock Exchange of Hong Kong, has any doubts about the sponsor, such as compliance, integrity, professional ability, etc., it can refer the relevant situation to the SFC, Securities and Futures Commission, for investigation or handling, okay? The most important thing to remember is that a sponsor is needed before listing, understand? So what exactly does a sponsor need to do? And what does it need to report to the SEC, Stock Exchange of Hong Kong? The sponsor helps companies to go public, but if it finds that the company it is assisting has some parts that do not comply with the listing rules, it must report to the SEC. If it finds that the information provided by the issuer it is serving is inaccurate or does not comply with laws or regulations, it must report to the SEC. If the sponsor changes from being independent to not being independent, it must report to the SEC. Okay? If the sponsor is fired before the listing, or if it resigns, it must provide an explanation and report to the SEC the reason for no longer being a sponsor. So what is the real, actual work of a sponsor? They provide concrete advice, such as on corporate structure and governance, finance, listing process, etc. Participate in the preparation of the new applicant's listing documents. Accompany the new listing applicant to attend meetings of the SEC, Stock Exchange of Hong Kong. In addition, they conduct due diligence for the transaction to ensure that the documents and regulations of the new listing applicant are legal and compliant. In simpler terms, they help a listed company to go public, ensuring that the listed company is legal and compliant. In addition, they help the company preparing for listing to prepare documents. Remember the term due diligence, which is to ensure that the listed company meets the listing requirements, the information provided is accurate and correct, and there are no fraudulent or false situations, okay? The listing applicant also needs to appoint an overall coordinator, so who should be chosen for this role? An independent sponsor can be chosen to serve, or an overall coordinator can be appointed from a company in the same group as the independent sponsor. So what does the overall coordinator do? The overall coordinator is mainly responsible for the overall management of the offering during the listing process, including book building activities, i.e., recording the investment intentions of investors. In addition, they will also provide advice on the issue price and share allocation, as well as exercising discretion in share allocation activities, such as adjusting the plan for share allocation when demand exceeds expectations. Remember, this job is performed by an independent sponsor, that is, the so-called sponsor coupling. What's the difference between a compliance advisor and a sponsor? A compliance advisor is actually a professional advisor, providing an independent opinion to the listed company, ensuring that the listed company meets the compliance requirements of the SEC, Stock Exchange of Hong Kong. Remember, when a company wants to apply for listing, it needs to appoint a sponsor to handle the application. After successful listing, it needs to find a compliance advisor to ensure continuous compliance. So when specifically should a compliance advisor be appointed? A listed issuer must appoint a compliance advisor from the date of its initial listing. How long does a compliance advisor need to be appointed? If it is a company listed on the main board, it needs to be appointed for 1 year. As for the GEM, because its risk is higher, it needs to be appointed for 2 years. Different from the sponsor, the compliance advisor only needs to provide opinions and guidance when requested by the listed issuer. So I ask you, if the listed issuer has not asked you for opinions and guidance, do you need to take the initiative to do it? No need, okay? So under what circumstances does a listed issuer usually need to seek the opinion of the compliance officer? For example, before publication of any regulatory announcement, circular, or financial report, in these specified situations, the listed issuer needs to seek the opinion of the compliance advisor. Then let's talk about independent financial advisors. An independent financial advisor is a professional finance advisor. They mainly provide independent, neutral opinions to shareholders or those preparing for acquisitions or being acquired. For example, if a company has some transactions that require shareholder approval, then it will consult an independent financial advisor to analyze the situation of this matter, such as looking at the impact of the transaction on the company, evaluating the company's financial situation, and suggestions for investment strategies. Or, the company is being acquired and has received a takeover offer regulated by the Takeover Code. Then the independent financial advisor has to tell the shareholders, is this acquisition fair and reasonable? What should it be worth? If you are preparing to acquire other companies, then you can also give the independent financial advisor some advice, okay? Does a listed company have to have an independent financial advisor? Yes, every listed issuer must appoint an independent financial advisor. There must be an independent financial advisor. And this independent financial advisor should take due diligence, that is, check clearly that the listed company, that is, the listed issuer, is okay, all right? Remember, independent financial advisors, like the other two professionals, must also comply with the listing rules. If the SEC, Stock Exchange of Hong Kong, or the SFC, Securities and Futures Commission wants to investigate certain matters, can the independent financial advisor say, "I didn't follow this matter, I won't participate in the investigation"? The answer is no. They must cooperate. Moreover, the independent financial advisor has to submit a declaration of independence to the SEC to prove their independence. Because what is their name? Independent financial advisor. What methods can be used for the initial public offering of new shares on the SEC, Stock Exchange of Hong Kong? There are 4 ways. The first is to issue new shares, which is called an offer for subscription. This is very easy to understand, that is, the company issues new shares, and then the public can subscribe. The second is an offer for sale, that is, the sale of unlisted securities held by existing shareholders to the public, so that the public holds more shares. The third is placing, where the listed company selects certain people to sell shares to, thereby increasing the circulation of the company's shares, so that they can be bought and sold on the stock market, that is, the SEC. The last one is called introduction, that is, secondary listing. This stock has already been listed elsewhere, and it is just moved to Hong Kong for listing. For example, Alibaba, NetEase, and JD.com were listed in the United States before, and now they are listed in Hong Kong, so we call it introduction. Okay? So, after a company has gone public, can it issue more shares? Are the shares fixed? No, they are not. For instance, if a company issued 100 million shares during its initial public offering, it can still issue more shares later if it needs to raise more funds, okay? So, how can it do this? Firstly, it can do a rights issue, which is issuing new shares and asking existing shareholders to put in more money to buy more shares, thus raising more capital for the company. Secondly, it can do an open offer, selling new shares to the public. Thirdly, it can do a capitalization issue, also known as a bonus issue of shares, which means the company converts its profits into share capital and then distributes it to existing shareholders. This is not common, so we won't talk much about it. Fourthly, it can do a consideration issue. A consideration issue is a very special concept. You often hear about buying a shell for listing or borrowing a shell for listing, which is actually doing this. It means using the shares of your own listed company to buy other people's assets. These assets can include buildings, parking lots, etc. By issuing new shares, you can buy other people's things. The person who sells the assets, the car, the buildings to you, then has more shares in your company. If they sell enough, this person who sells the assets becomes a substantial shareholder, which is called borrowing a shell for listing. Okay? Fifthly, it can exchange securities and replace original securities. This usually happens during a reorganization or merger, where the company will issue new securities to replace or exchange the original securities. Sixthly, it can transition from the GEM, Growth Enterprise Market, to the main board. That is, when a small company has grown to a certain extent and can meet the listing requirements of the main board, it can transition from GEM to the main board. There are other ways as well. As long as you know their names, that's okay. What are equity securities? They are the ordinary shares issued by a listed company, okay? So, how can a company issue equity securities or go public? Well, a listing issuer needs to meet the following conditions to list ordinary shares. Firstly, you must have at least 3 years of operating record. During this period, the management team remains largely the same, and in the most recent year, the ownership of the shares has not changed significantly, meaning the shareholders have not changed much. There has not been a major reshuffle. After meeting the above conditions, you need to meet a quantitative test. The quantitative test is to check whether the company is financially stable and has sufficient financial resources and strength to go public. In special circumstances, the SEC, Stock Exchange of Hong Kong, can waive the above requirements, okay? So, what are the profit figures for the listing requirements of the main board of the SEC, Stock Exchange of Hong Kong? What is the final requirement of the quantitative test? Firstly, the market value of the listing applicant cannot be less than 500 million. Among them, the market value held by the public cannot be less than 125 million. Additionally, there are 3 quantitative tests, but you only need to meet one of them. That is, if you meet the profit test, you don't need to meet the market capitalization/revenue/cash flow test, understand? Remember, out of the 3 tests, you only need to pass one. Let's take a look at the requirements for these 3 tests. 1. Profit test. To meet the profit test, you must have at least 35 million profits in the past 1 year, and at least 45 million profits in the past 2 years. 2. Market capitalization/revenue/cash flow test. To meet the market capitalization/revenue/cash flow test, the market capitalization must be at least 2 billion, the revenue in the past year must be at least 500 million, and the cash inflow in the past 3 years must be at least 100 million. 3. Market capitalization/revenue test. To meet the market capitalization/revenue test, the market capitalization must be at least 4 billion, or the revenue in the past year must be at least 500 million. No matter which test, there must be enough shareholders. How many are enough? At least 300 shareholders, okay? For different types of companies to go public, the listing rules have some additional provisions. Let's first look at the listing requirements for biotech companies. Do you know what a biotech company is? Is it about developing new drugs, genetic modification, etc.? Almost. To be more precise, biotech companies mainly use science and technology for research and development, application, or commercialization of products in the medical or other biological fields. However, biotech companies may not make money so quickly, because the research and development costs are high and the process is long. So, the listing rules mentioned earlier may not be suitable for biotech companies. So what to do? How can these companies go public? The SEC, Stock Exchange of Hong Kong, allows, as long as biotech companies meet the suitability and disclosure regulations, they can enter the public capital market without passing any quantitative tests in the early stages when they have not yet generated revenue. The listing requirements are as follows. 1. The company's management has been substantially the same for 2 years. 2. Have a 2-year trading record period. 3. Have an initial market capitalization of at least 1.5 billion Hong Kong dollars. 4. Have a public float at the time of listing of at least 375 million Hong Kong dollars. However, the shares held by cornerstone investors are not included in the public float. Wait a minute. So what is a cornerstone investor? Cornerstone investors are the big guys. That is, large and influential investors. Before going public, the company has already reached an agreement with the cornerstone investors. They agree to buy a specific number of shares in advance, providing solid capital support for the company about to go public, and conveying a positive evaluation of this company. Let's then talk about the listing requirements for SPACs, Special Purpose Acquisition Companies. What is a SPAC? How special is it? A SPAC is a company established to raise funds that will be used to acquire businesses. In other words, the purpose of these companies going public is just to raise money and then to acquire. First raise money, then acquire. However, whether the acquisition can be successful is another matter. So what are the requirements for a SPAC, Special Purpose Acquisition Company, to go public? The total amount of funds raised in the initial offering must be at least 1 billion Hong Kong dollars. Moreover, the securities issued by the SPAC can only be traded by professional investors. That is, non-professional investors, such as the public, are not allowed to trade. In addition, it must comply with the listing regulations and other provisions of the listing rules. What does a SPAC, Special Purpose Acquisition Company, need to do if it wants to go public? Do they need to appoint a sponsor? Correct. Like other listing issuers, it needs to appoint a sponsor to handle the listing application. The SPAC must be allowed to go public within a specified period, usually 24 months. After being allowed to go public, the SPAC has a task, which is to complete the merger and acquisition transaction. What does that mean? That is, within 24 months from the listing date, they need to find a suitable acquisition business. Moreover, the entire acquisition process must be completed within 36 months from the listing date. Looking at the timeline on the PowerPoint, have you noticed anything strange? Generally, listing issuers only appoint sponsors before listing, but SPACs need to appoint sponsors to handle acquisition matters after listing. So, you now know how special it is? What is a company with different voting rights? It is a company that adopts a weighted voting right structure or a dual-class share structure when it goes public. I don't understand. So what does that mean? Simply put, it means that the shares of the same company have different voting rights, that is, same shares, different rights. Usually when a company goes public, ordinary shares will follow the one share, one vote principle, that is, each ordinary share has equal voting rights. If a listed company adopts a weighted voting rights structure or a dual-class share structure, the shares will be divided into different categories, giving the holders different voting rights. Let me give you an example. Kaohsiung Securities issues A shares and B shares at the same time. Class A shares are ordinary shares, one share, one vote. While Class B shares may have 10 votes per share, this is a dual-class share structure. So does that mean that the holder of B shares has greater control? The answer is yes. Why do they do this? It is to allow certain shareholders, such as the company's founders or senior management, to retain greater control over the company. What are the listing requirements for companies with weighted voting rights? 1. Applicable to companies with elements of innovation and growth. 2. Must pass one of the following two tests: A. Market capitalization greater than or equal to 40 billion Hong Kong dollars, or B. Market capitalization greater than or equal to 10 billion Hong Kong dollars, and revenue greater than or equal to 1 billion Hong Kong dollars in the most recent fiscal year. 3. Comply with the provisions of the listing rules on the creation, holding, transfer, and attached voting rights restrictions of weighted voting rights shares. So, what are the differences between the listing requirements of the GEM and the main board? The listing eligibility requirements of the GEM are not as high as the main board, and a business record of only 2 years is required. The SEC, Stock Exchange of Hong Kong, can also accept shorter business records because the company is relatively new. So you can look at the table, which compares the listing conditions of the main board and the GEM. Obviously, the requirements of the GEM are relatively lower. What is a share scheme? Simply put, it is a reward given by the company to directors or employees. So what is used as a reward? Not chocolate, not flowers, and certainly not gift cards. When it comes to share schemes, the reward is new shares or options for new shares. Why is there a share scheme? What are the benefits to the company of giving out these shares or options? The main idea is to incentivize directors or employees to create more value for the company, letting them know, if you work harder, you will benefit when the company profits. This aligns their interests with the long-term goals of the company. So does the company have to set up a share scheme? No, it's voluntary for the company. If a company wants to implement this share scheme, do you know what regulations need to be followed? First of all, the provisions of Chapter 17 of the Main Board Listing Rules must be followed. Also, the terms of the scheme are included in the scheme document issued to shareholders. Wait. There's a question: does the establishment of a share scheme require shareholder approval? In the first case, before listing, the company has decided to establish a share scheme. Then after you go public, you don't need to go through shareholder approval again. However, the material terms of the scheme must be clearly set out in the prospectus, okay? In the second case, after listing, the company decides to establish a share scheme, then it needs to get the approval of shareholders first. When a company issues shares or options, can they be supplied without limit? No, they can't. Even the rewards have a limit. The scheme mandate limit, i.e., the total number of shares or options as rewards, cannot exceed 10% of the issued shares of the relevant category at the time the scheme was approved. So, does the share scheme have a term? Of course, it does. The exercise period of the option, counted from the date of grant, cannot exceed 10 years. As for the share scheme, the life of the scheme also cannot exceed 10 years. So what are the regulations for share schemes? They have to comply with the restrictions on the exercise price of options, or the purchase price of the awarded shares. If a company wants to reward certain people, it must first get the approval of INDs, independent non-executive directors. This includes directors, chief executives, substantial shareholders, and their associates. Let's guess. When an independent non-executive director receives a reward, does he need to approve himself? No need. Next, let's talk about a very important topic, called price stabilization. Stabilizing action, simply put, is price support. In Hong Kong, price support is legal. So how can you support the price? After an IPO, initial public offering, the issuer, i.e. the listed company, and its underwriters can take a price stabilizing action. For example, the issuer buys it himself or restricts the supply of new securities. Why do you need to support the price? It is to prevent the stock price from falling too quickly. After an initial public offering, newly issued securities may face violent fluctuations in market prices. In order to maintain market stability, increase investor confidence, and protect their interests, it may be necessary to take stabilizing price actions. You might think, isn't that illegal? Generally speaking, price support is considered market manipulation and is improper conduct. However, the SFC, Securities and Futures Commission, believes that price stabilizing actions related to public offerings are in the public interest, so it has specifically formulated the PS rules, Securities and Futures, Price Stabilizing Rules. If the issuer and the underwriter take the stabilizing price action in accordance with the rules, then it will not be considered as market misconduct, it is legal and compliant, okay? In addition, be aware. Listed companies have some transactions that need to be disclosed to the public and the exchange. These transactions usually involve the acquisition and disposal transactions by a listed company. What are disposal and acquisition transactions? Disposal, that is, you sell some assets in exchange for other people's shares. Acquisition, that is, selling some shares in exchange for other people's assets. Okay? Why disclose transactions? Because it is a listed company, its actions will affect the stock price, affecting your, my, and its wallet. When investors, analysts, or other market participants understand the significant transaction information of listed companies, they can make more informed investment decisions. Therefore, the disclosure of transactions is mainly to increase market transparency, protect the interests of investors, and ensure the fair operation of the market. So what are these disposal and acquisition transactions? How to distinguish them? You can look at this table. In fact, they are mainly classified according to the percentage of shares involved, remember. If the percentage of share transactions is less than 5%, it is a share transaction. If the ratio is more than 5 but less than 25, it is called a disclosable transaction. Disposals over 25% but less than 75% and acquisition items over 25% but less than 100% are called major transactions. Very substantial disposals are disposals where any percentage ratio is 75% or more. Very substantial acquisitions are acquisitions where any percentage ratio is 100% or more. Next, let's talk about connected transactions. Connected transactions are transactions between a listed issuer and its connected persons. Do you remember who the connected persons are? For example, directors, chief executives, substantial shareholders, and subsidiaries. These are individuals or entities that can control the company or exert significant influence, all of which are called connected persons. Regarding connected transactions, we try to disclose as much as possible to the public. It must be disclosed, it must be reported. Why should we be particularly careful about these connected transactions? Because when the directors, substantial shareholders, and chief executives of the issuer do some connected transactions, that is, their own relatives and friends, or their own controlled companies, when they do these connected transactions, they may obtain some improper benefits, or other shareholders can't get the benefits, therefore affect corporate governance, and there may be some serious conflicts of interest. So for the overall interests of shareholders, not just the interests of individuals or institutions with specific relationships with the company, related transactions must be disclosed, must be reported, okay? Before a listed issuer group enters into a connected transaction, it must consult with the SEC, Stock Exchange of Hong Kong, in advance if the following situations are involved. First situation, in the past 12 months, when the transactions of the listed issuer group enters these transactions with the same party or parties who are connected with one another, or involving the sale and purchase of part of the assets or securities/equity of a company, or it will lead to the listed issuer group's substantial participation in a new business. Second situation, the transaction will involve the acquisition of assets. Who to acquire from? It is to acquire from an entity or group that has gained control of the listed issuer in the past 24 months. If these two situations are met, the SEC must be consulted in advance before the transaction. After the transaction, the listed company still needs to provide the information of the transaction to the SEC, Stock Exchange of Hong Kong, which will decide whether to aggregate the transactions. Trading suspension means the cessation of trading. People often hear about a certain stock being suspended, but does this mean your stock has disappeared? No. Suspension just means that this stock is no longer being traded. In other words, you can't buy or sell this stock anymore. So why does the suspension occur? It's to protect investors and maintain an orderly securities market, okay? Suspension can be divided into two types, trading halt and trading suspension. A trading halt is a suspension that does not exceed 2 trading days. The main purpose is to wait for the disclosure of information. If a trading halt exceeds 2 trading days, it will automatically become a trading suspension. Do you understand? So why do we need a trading halt? To ensure fair market trading. By temporarily interrupting trading, unfair trading caused by the non-disclosure of important information can be avoided. When does a listed issuer need to apply for a trading halt? First, when appropriate disclosure has not been made. If there is information that the listed issuer must disclose, but they have not done so, they can apply for a trading halt. What kind of information is this? Material information that must be disclosed under the main board listing rules, and inside information as stipulated by the Securities and Futures Ordinance. If the listed issuer reasonably believes that some confidential inside information may have been leaked, they can also apply for a trading halt. What kind of inside information is this? Inside information that has been exempted from disclosure, prohibited, or kept confidential. Furthermore, the listed issuer wants to issue an announcement in response to market commentaries or rumors. If there are adverse rumors or commentaries in the market, such as allegations of fraud by the listed issuer, material accounting or corporate governance irregularities, etc., what can be done? The listed issuer can apply for a trading halt and publish an announcement as soon as possible to minimize the impact on the market. Regardless of the type of trading halt, it can be requested by the issuer, initiated by the SEC, Stock Exchange of Hong Kong, or done at the request of the SFC, Securities and Futures Commission. That is, there are 3 parties that can request a stock to be halted. First is the SEC. Second is the listed issuer. Third is the SFC. If the SEC, Stock Exchange of Hong Kong, wants to halt your trading, it may be because you have not complied with the listing rules, so it will suspend your trading. In addition, if the number of shares held by the public is insufficient, or the SEC believes that your business operations do not have sufficient operations or asset support to ensure that the stock can continue to be listed, or even if the SEC believes that you are not suitable to continue to be listed, these reasons can all lead to a trading halt. A listed issuer, i.e., the listed company itself, can apply to the SEC, Stock Exchange of Hong Kong, for a trading halt, but it must have specific reasons to support it. The SEC will consider the actual situation and whether it really needs to be halted. Therefore, whether to halt trading is not up to the listed company, but is decided by the SEC. The SFC, Securities and Futures Commission, also has the power to order a trading halt. It can, according to the Securities and Futures Stock Market Listing Rules, request the SEC, Stock Exchange of Hong Kong, to suspend the trading of any securities under certain circumstances. So, under what circumstances would the SFC request a trading halt? For example, when applying for listing, the listed issuer provides false, incomplete, or misleading information. Or, it subsequently discloses this misleading information publicly. Then the SFC may step in and request the SEC to halt its trading. What conditions do you need to meet to maintain your listing status? Firstly, the business you operate must have sufficient business operations and enough assets, whether tangible or intangible, to support operations. In simpler terms, you need to have a certain strength and financial capability, okay? What happens if a stock is suspended for a long time? It turns out that a long suspension could lead to delisting. Once delisted, not only can it not be traded on the SEC, Stock Exchange of Hong Kong, but the stock will also disappear and no longer have a listed status. Accordingly, the listed company will become a non-listed company. At this point, you might ask, what are the usual reasons for a listed company to be delisted? There are several main reasons. Firstly, the listed company does not have enough operational strength or assets and is financially insufficient. That is, it can no longer meet the requirements for continued listing. For example, ceasing operations due to financial difficulties, insolvency, or losing its major operating subsidiaries, etc. The second reason is that the number of securities held by the public is insufficient. These two reasons are similar to the reasons for the SEC to suspend trading. Also, it has been continuously suspended for 18 months. That is, if a listed company is suspended for a long time, but has no measures to restore its listed status, it may be delisted by the SEC. Can a listed company voluntarily withdraw its listing? Under normal circumstances, a listed company cannot delist itself unless it has the approval of its shareholders. Once it has the approval of its shareholders, the listed company can be delisted. Regarding disciplinary procedures, remember that the SEC, Stock Exchange of Hong Kong, can penalize those who violate the listing rules. Who can the disciplinary proceedings be initiated against? Firstly, the listed issuer, i.e., the listed company. Secondly, specified persons, including directors, senior management, and substantial shareholders of the listed company. So, is it illegal to violate the listing rules? Will it lead to imprisonment? Remember, the listing rules are not laws, so there will be no imprisonment. Does that mean you can get away with it? Not at all. The SEC, Stock Exchange of Hong Kong, can take some disciplinary sanctions. So, what are these sanctions? The main goal of disciplinary sanctions is to protect the public and the fairness of the market, and to deter similar misconduct. Therefore, disciplinary sanctions mainly include private reprimands, public statements, public censures, prohibition of the use of exchange facilities, suspension of trading, delisting. It may also report the violation to the SFC, Securities and Futures Commission, or to other regulatory bodies such as the HKMA, Hong Kong Monetary Authority. In the future, it may also prohibit brokers, professional advisors from participating in the listing of the listed issuer, or require the violator to make compensation or remedial actions. So if you think the decision of the SEC, Stock Exchange of Hong Kong, is unfair to you, or if you are dissatisfied with the decision, what can you do? First, you can tell the listing committee of the SEC that you are dissatisfied with the decision and want to request a review, and then see if there is a possibility to change the decision. So if they don't agree to the review, or if you are still dissatisfied with the result of the review, what else can you do? Don't worry. You can take the second step, find a body called the Listing Review Committee for further and final review. The SFC, Securities and Futures Commission, can also request the Listing Review Committee to review any decision of the Listing Committee. We have already introduced the listing rules for equity securities, i.e., ordinary shares. In addition to equity, there are many other types of securities on the SEC, Stock Exchange of Hong Kong, for public investment. Some of these securities are related to equity, such as depositary receipts, warrants, and options. Some are unrelated to equity, such as debt securities, for example, bonds, and there is a category of investment products called structured products. Let's talk about Hong Kong depositary receipts. People often talk about depositary receipts, but what exactly are they talking about? Whether it's American depositary receipts or Hong Kong depositary receipts, a depositary receipt, in simple terms, is actually just a piece of paper. This piece of paper is traded on the main board of the SEC, the Stock Exchange of Hong Kong. So, who issues this paper? The listed company? No. This paper is issued by a depositary. Are you confused? Don't worry. Let me give you an example. Suppose there is a stock called Faro listed on the Egyptian Stock Exchange. It's not easy for Hong Kong investors to buy Egyptian stocks. So this company, Faro, finds a custodian in Hong Kong and deposits some of its Faro stocks with this custodian. The custodian then issues some papers and trades these papers on the Hong Kong Stock Exchange. Why are these papers so valuable? Because these papers can be exchanged for Faro stocks. For example, one paper can be exchanged for one Faro stock. These papers are called depositary receipts. That is, you take some papers to the custodian and you can exchange them for Faro stocks. Is this paper Faro stock? No, it's just a piece of paper, a piece of evidence, that can be exchanged for Faro stock. Why are these papers so valuable? Why are people willing to buy and sell them? Because these papers can be exchanged for Faro stocks. For example, one paper can be exchanged for one Faro stock. These papers are called depositary receipts. That is, you take some papers to the custodian and you can exchange them for Faro stocks. Is this paper Faro stock? No, it's just a piece of paper, a piece of evidence, that can be exchanged for Faro stock. So, what are the benefits of depositary receipts? It allows investors who cannot participate in other investment markets to buy stocks in other markets through this indirect method. The so-called Hong Kong depository receipts enable investors in Hong Kong to acquire overseas stocks. One example you may hear about most often is United States depository receipts. For instance, HSBC and China Mobile are not listed in the United States. So, how can individuals in the United States buy shares in China Mobile or HSBC? It's through the model of depository receipts. Simply put, Hong Kong stocks, once repackaged as United States depository receipts, can be acquired by investors in the United States. Similarly, foreign companies can repackage their stocks into depository receipts and trade these on the Hong Kong Stock Exchange. However, remember, what is listed on the main board are depository receipts, which are essentially papers that prove you own the overseas stock, rather than the overseas stock itself being listed on the main board. Furthermore, depository receipts can only be listed on the main board and cannot be listed on the Growth Enterprise Market, GEM, and there are also no depository receipts listed on the GEM. Let's introduce what a warrant is. What is a warrant? A warrant, also known as an equity warrant, is listed as an equity warrant on the exchange product list. A warrant gives the holder the right, not the obligation, to subscribe to the issuer's shares, so the value of the warrant is derived from the underlying stock. In other words, the warrant holder can buy some company's stock at a specific price. So where do you think these warrants are traded? The answer is on the SEC, Stock Exchange of Hong Kong. Warrants are American style. That is, on any day before expiration, you can buy this stock at a specific price. Who issues the warrant? Why issue it? Warrants are issued by listed companies and sold to the public to raise funds. After the listed company sells the warrant, it can obtain funds. Does it sound familiar? Yes, it's actually very similar to a stock option, both of which give the holder the right to buy equity securities, not the obligation. Remember, it's a right, not an obligation. So what's the difference between a warrant and a stock option? Although both are traded on the SEC, Stock Exchange of Hong Kong, there are many differences. Warrants are issued by listed companies, they are securities, and they are settled by the HKSI, the Hong Kong Securities Clearing Company Limited. If you remember, we said that stock options are monsters, they are issued by the exchange, they are options, but they are settled by SEC, the SEC Options Clearing House Limited. The exercise price and exercise period of a warrant are only one, determined by the listed company. However, the exercise price and exercise period of a stock option can have multiple choices. If a warrant is exercised, the listed company will issue new shares to the warrant holder. What about stock options? They do not involve the issuance of new shares. Finally, warrants cannot be short-sold, but stock options can be short-sold. So what are the benefits for a listed company to issue warrants? The benefits of issuing warrants are as follows. Firstly, it can help the company raise new capital. Secondly, the cost of issuing warrants is not very high. These warrants can be traded on the SEC, Stock Exchange of Hong Kong, which is easier to attract investors because it is more fair, open, and transparent. In addition, some companies will use warrants instead of distributing cash dividends. In this case, when the company is not doing well, but still wants to appease the shareholders and give them some return, they can distribute warrants. This not only ensures that the company will not lose too much cash, but also attracts and maintains shareholders or investors. When the warrants are exercised, it will increase the shareholder base. So what are the benefits of warrants for investors? Actually, the uses of all speculative tools are similar, mainly for speculation. Warrants allow investors to gamble and speculate on the rise and fall of stock prices without holding voting rights. Secondly, investors can use warrants for hedging. If you hold a lot of stocks and are afraid that they will fall, you can buy some warrants to hedge against the risk of stock price decline. Warrants also have a leverage effect, allowing you to speculate on the rise and fall of more stocks at a lower cost. Like all things, warrants also have their disadvantages. What are they? Like other speculative tools, if the market is not very active and there are few buyers and sellers, it can lead to poor liquidity, making it difficult to sell after buying. There is also the risk of leverage. That is, if an investor buys a stock expecting it to rise, and the stock does rise, the investor makes a lot. But if they buy expecting it to rise and the stock plummets, due to the leverage effect of the warrant, the loss will be magnified. In addition, warrants have a time limit. If you buy a stock and the price plummets afterwards, it's not a big deal because you can wait for it to rebound, but warrants are different from stocks. If the price falls after buying, investors cannot hold it for a long time waiting for it to rise again, because the warrant will be invalid after the time limit. So investors must be very sensitive to time. Basically, they cannot hold for a long term. Moreover, the holders of warrants are not shareholders of the company before the warrants are exercised, so they do not have voting rights and cannot participate in the company's decision-making. What could happen? The company's decisions may affect the interests of the warrant holders. For example, I bought some equity warrants, that is, call equity warrants. Theoretically, a rise in the stock price is beneficial to me, isn't it? But the company's directors are not doing a good job, so if I am a shareholder, I can vote to remove them. But can the holders of call warrants do this? No, because they do not have voting rights. Everyone should pay attention to this point. What should a company that wants to issue warrants on the SEC, Stock Exchange of Hong Kong, do first? They must first obtain approval from the SEC. So, what are the requirements of the SEC? The number of warrants cannot exceed 20% of the number of shares already issued by the issuer. In addition, the SEC stipulates that the expiry date of the warrants cannot be less than 1 year and cannot exceed 5 years. Stock options are different. They do not have such specific expiry date restrictions. Their expiry date is mainly determined by the contract and the market. Okay, let's introduce derivative warrants next. What are derivative warrants? As the name suggests, derivative warrants are a type of derivative product. What does derivative product mean? It is a financial instrument derived from the value of other assets, also known as underlying assets. These underlying assets can be stocks, bonds, commodities, interest rates, exchange rates, etc. Derivative warrants give the holder the right, but not the obligation, during a specific predetermined exercise period, 1. To buy or sell a specific amount of underlying assets from the issuer at a predetermined exercise price. The underlying assets can be securities or assets, or 2. To obtain cash from the issuer based on the price difference between the index value and the exercise price. Derivative warrants mainly have 2 basic types: call warrants and put warrants. Call warrant: when the warrant holder exercises the call warrant, if the value of the index, or underlying asset, is higher than the exercise price, the warrant holder can get the difference between the two from the issuer. Suppose you hold a call warrant with an exercise price of 100 Hong Kong dollars, and the current index value is 120 Hong Kong dollars. In this case, you can get the difference of 20 Hong Kong dollars from the issuer. Put warrant: when the warrant holder exercises the put warrant, if the exercise price is higher than the value of the index, or underlying asset, the warrant holder can get the difference between the two from the issuer. Suppose you hold a put warrant with an exercise price of 100 Hong Kong dollars, and the current index value is 80 Hong Kong dollars. In this case, you can get the difference of 20 Hong Kong dollars from the issuer. First, do you remember what derivative warrants are? As mentioned before, they are a type of derivative product. In addition, they are one of the types of structured products that can be listed on the SEC, Stock Exchange of Hong Kong. Where are these derivative warrants listed on the SEC? They can only be listed on the main board of the SEC. In other words, are there any derivative warrant transactions on the GEM? No. Holders of derivative warrants, like others, only have rights and no obligations. So who issues these derivative warrants? They are issued by independent third parties, i.e., unrelated to the issuer of the related assets. Generally speaking, they are investment banks. According to the main board listing rules, the issuer of derivative warrants must be incorporated and cannot be a private company. In addition, the issuer of non-collateralized derivative warrants has other requirements, and they need to meet one of the following conditions. 1. The issuer's net assets are not less than 2 billion Hong Kong dollars, and they must obtain the specified credit rating. Or 2. They are regulated by a specific regulatory authority, either the HKMA, Hong Kong Monetary Authority, or the SFC, Securities and Futures Commission, or a government or state. We've talked about warrants and derivative warrants. Both are warrants. So what's the difference between them? In fact, warrants can be divided into 2 major categories: equity warrants and derivative warrants. Both are derivative investment tools. The difference is that the issuer of an equity warrant is a listed company. If this warrant is exercised, the listed company will issue new shares to the warrant holder, and the listed company can obtain additional funds. What about derivative warrants? They are not issued by listed companies. They are issued by a third party, that is, an independent third party unrelated to the listed company. Nowadays, almost all derivative warrants in Hong Kong are cash settled. Therefore, if a derivative warrant is exercised, the holder usually does not receive physical shares, and no new shares will be issued. So can derivative warrants raise funds for listed companies? The answer is no. Why? because they are issued by a third party, an investment bank. So it's purely a speculative tool, it can't raise funds for the company, okay? The value of a warrant is derived from the shares of the issuer, i.e., the listed company, with a validity period of 1 to 5 years. The related assets of derivative warrants can be ordinary shares, market indices, foreign currencies, or a basket of shares. The validity period is usually from 6 months to 5 years. Have you ever thought about what a company or government would do if they don't have enough money? One way is to issue bonds. Debt securities are a type of financial instrument that represents debt. Simply put, you can think of it as an IOU. When a company or government wants to issue bonds, it is essentially borrowing money from investors, agreeing to repay the principal and pay interest at a future date. What are some common debt securities? Corporate bonds, government bonds, municipal bonds, etc. The issuance of these debt securities is usually used as a financing method for companies or governments, that is, to raise funds. And those who buy bonds hope to earn a stable return. Chapters 22 to 37 of the Main Board Listing Rules mainly provide listing guidelines for different debt instruments. That is to say, bonds, including convertible securities and asset-backed securities, can be listed on the main board of the SEC, Stock Exchange of Hong Kong. There are many different types of investment products listed on the SEC, Stock Exchange of Hong Kong, including structured products, CISs, collective investment schemes, exchange-traded funds, and REITs, real estate investment trusts. We will introduce the relevant content in the subsequent chapters. Okay, let's now introduce the codes on takeovers and mergers and share buybacks, also known as the codes. Why is it called codes? Because one is about takeovers and mergers, and the other is about share buybacks. It's simple. So, do the codes have the force of law? No, the codes are actually self-regulatory codes and have no legal effect. However, if the codes are violated, it is equivalent to violating the listing rules and may be banned from entering the securities market. So who is responsible for overseeing the implementation of the codes? The Corporate Finance Division of the SFC is responsible for overseeing the implementation of the two codes. Their executive director, i.e. the executive, is responsible for the daily implementation of these codes, providing consultation on share affairs, and making decisions. What is the purpose of the codes? It is to regulate the activities of takeovers, mergers, and share buybacks in Hong Kong. So, which companies are regulated by the codes? Firstly, it mainly applies to public companies in Hong Kong. Note, listed companies are necessarily public companies, but not all public companies are listed companies. Secondly, it applies to companies with a primary listing of their equity securities in Hong Kong. For example, a company established in the mainland comes to Hong Kong for listing, and it is not listed anywhere else. In this case, the company's activities of takeovers, mergers, and share buybacks will be regulated by the codes. In addition, some REITs, real estate investment trusts with a primary listing of their units in Hong Kong, are also regulated by the codes. So, do companies listed outside of Hong Kong need to comply? No, they can be exempted from complying with the codes. What is a public company in Hong Kong? Does it have to be established in Hong Kong to be a public company in Hong Kong? The answer is no. Did you notice a restaurant inheritance dispute in Central before? That company is a BVI company. What is BVI? That is, a company registered in the British Virgin Islands, BVI. But it turns out to be a Hong Kong company. Why? Because its shareholders are in Hong Kong, its business is in Hong Kong, and its shareholders are in Hong Kong. In this case, it is a Hong Kong company. When the executive officers confirm whether a company is a public company, they will consider several things: how many shareholders it has in Hong Kong, how active its shares are traded in Hong Kong, where the head office is, and where the business and assets are located, to judge whether a company is a public company in Hong Kong. What are the general principles of the codes? The main principles are: ensure that shareholders are treated fairly. When the control of the company changes, the organization or individual who gets the control of the company should propose to all shareholders to buy their shares, that is, to make a general offer. Information related to the offer should be disclosed as soon as possible. During the acquisition and merger, the acquirer should ensure that it has sufficient financial strength to complete the acquisition, and minority shareholders should not be oppressed. If you plan to acquire this company, you cannot oppress these minority shareholders, especially companies without major shareholders, okay? Also note that not only the directors of the company making the acquisition, but also the directors of the company being acquired, should provide opinions on the acquisition and merger. In addition, the company being acquired should not take any obstructive actions without the consent of shareholders, that is, it should not hinder others from acquiring their own company. If someone wants to acquire your company, you can vote to decide whether to agree, but don't do unnecessary actions to prevent others from acquiring. Okay? Since the two codes regulate takeovers, mergers, and share buybacks, what is an offer? An offer is essentially a takeover, that is, a proposal by a company or individual to acquire another company's shareholders. Offers can be divided into two types: mandatory offers and voluntary offers. What is a voluntary offer? All offers that are not mandatory offers are voluntary offers. It feels like playing a word game, doesn't it? So let's see, what is a mandatory offer? When there may be a change in control of the company, the new or existing major shareholder must make a formal proposal to buy their shares, that is, make a full offer. This is a mandatory offer. To be clear, a mandatory offer must include a cash portion, that is, as an acquirer, you must come up with some cash to buy people's shares. For voluntary offers, this is not necessary. So when to make a voluntary offer? Anytime, you can do it whenever you want. And for mandatory offers, the following two conditions must be met before they are automatically triggered. 1. When the shareholding of a certain or group of shareholders increases from less than 30% to more than 30%. For example, from 28% to 30%, or from 29% to 31%. In this case, a mandatory offer must be made, that is, you have to acquire the remaining 70% of the shares. 2. If the shareholding of a certain or group of shareholders is originally between 30% and 50%, and it has increased by more than 2% in the past 12 months, a mandatory offer must also be made. In other words, when the shareholding reaches the trigger point of 30%, or in the case of already holding 30% to 50% of the shares, the shareholding increases by more than 2% in 12 months. Creeper. Both situations require the relevant shareholders to initiate a mandatory offer to other shareholders, unless exempted. Why is there a provision for mandatory offers? The main purpose is to protect the rights and interests of small shareholders. Major shareholders control most of the company's shares and play a leading role in company decisions, which may sometimes harm the interests of small shareholders. When major shareholders continue to increase their shares, the shares of minority shareholders will be correspondingly diluted, and their voting rights and influence in the company may become smaller. Therefore, in order to protect the rights and interests of small shareholders, many jurisdictions have mandatory offer provisions. If a shareholder's shares exceed a certain value, such as 30%, they must issue a purchase offer to all other shareholders. This ensures that all shareholders have the opportunity to sell their shares at the same price, and will not be deprived of this opportunity by shareholders who have the ability and willingness to trade privately. So how much should the acquisition price be at least? That is, how much is the minimum acquisition price? The highest price paid by the offeror, that is, the acquirer, for this stock in the 6 months before the offer period is used as the minimum acquisition price. That is, at least to reach the highest price you paid for this stock in the previous 6 months, you can initiate a mandatory offer. Do you understand? So what is the minimum acquisition price for a voluntary offer? The minimum acquisition price for a voluntary offer is the highest price paid by the offeror for this stock within the offer period or 3 months before the start of the offer period. Next, let's talk about share buybacks. Share buybacks are simple. It's when the issuer, i.e. the listed company, purchases its shares from its existing shareholders in the stock market. We call this share buyback. So why buy back shares? It could be for privatization, i.e. to convert a publicly listed company into a private non-listed company, or it could be due to agreements between the company and shareholders, or for restructuring, etc. Which shares can be bought back? All categories of shares issued by the listed company, including warrants and convertible bonds, can be repurchased by the listed company. If you violate the codes, you will be subject to disciplinary proceedings. Is this disciplinary proceeding conducted by the SEC, Stock Exchange of Hong Kong? No. Why? Who formulated the codes? They were formulated by the SFC, Securities and Futures Commission. Who is responsible for the daily supervision and execution of the codes? The executive directors of the Corporate Finance Division of the SFC, also known as the executive. Therefore, if someone violates the codes, the executive will initiate a disciplinary proceeding. If the Takeovers and Mergers panel confirms that someone has violated the codes, it can impose sanctions. What are the sanctions? Including public statements, public censure, affecting the fit and proper person qualification, prohibiting you from participating in activities, i.e. a cold shoulder order, SFC meetings, etc. However, violating the codes will not result in imprisonment. Remember this. What if you are not satisfied with the decision of the Takeovers and Mergers panel? You can apply for a review to the Takeovers Appeal Committee. There are many investment products listed on the SFC, Securities and Futures Commission website, all of which are authorized by the SFC and can be publicly offered in the market, such as unit trusts and mutual funds, structured investment products, mandatory provident fund schemes, exchange-traded funds, real estate investment trusts, etc. For details, please refer to the list of publicly offered investment products. If you want to issue similar investment products and offer them to the public in the Hong Kong market, you need to obtain the authorization of the SFC, okay? Next, we will mainly introduce collective investment schemes and structured products, also known as structured investment products, these two types. Collective investment schemes and structured products need to be authorized by the SFC before they can be sold to the public. In addition, advertisements related to the sale of collective investment schemes and structured products also need to be authorized by the SFC because your target audience is the public. The public does not include professional investors. If the advertisement is not aimed at the public, it does not need to be authorized by the SFC. For example, products specifically provided for professional investors do not need to be authorized by the SFC, okay? Please remember, collective investment schemes and structured products offered to the public and their advertisements must be authorized by the SFC. These regulations are clearly written in the Securities and Futures Ordinance. If you do not comply, it is illegal and you may go to jail. So, now let's introduce collective investment schemes. What is a collective investment scheme? Who defines a collective investment scheme? Remember, a collective investment scheme is defined by the Financial Secretary. So what are some important elements of a collective investment scheme? Remember the following three important elements. First, participants, i.e., investors in the scheme, do they participate in daily control? They do not participate in the daily control of the scheme assets, okay? Investors do not participate in the management. They only invest money and do not participate in management. Second, the contributions and accrued profits or returns of the participants are pooled. That is, hundreds or dozens of people invest together, and all assets and benefits are pooled together, okay? Finally, it is a very important point, the goal of the participants is to obtain profits or returns, that is, they invest for financial benefits. So, is it considered a collective investment scheme to participate in crowdfunding and invest in a movie together? Investors have invested money, but they do not participate in management, right? The answer is no. Why? Because the goal of investment is not to directly obtain profits and returns, but to make a movie work. This movie work may make money in the market in the future, but this is not a direct investment goal. It is formed through creation and production, and then needs to go through a commercial process to make a profit, so it does not count. There are many situations that are not considered collective investment schemes. For example, that is when the participants and the operator belong to the same company. That is, the investors and the managers are all part of the same company, such as private investment companies. These situations are not considered collective investment schemes, because these shareholders are involved in management. Franchises are also not included, such as the commonly seen 7-Eleven, Sugar Dessert, etc. These are brand franchises. They also raise funds for advertising, buying raw materials, renovations, etc., but the purpose of fundraising is to carry out commercial activities, such as sales or production of products, so these franchises are not included. In addition, there are solicitors acting in a professional capacity who collect money from clients during their work process to hold funds for clients such as buying property, inheritance, or litigation, etc. These are not included, because the management and custody of these funds are not for investment purposes, but to meet specific legal services. Okay? So, how can you offer a collective investment scheme to the public? If you want to offer to the public, there are two possibilities. First, you can list it on the SEC, Stock Exchange of Hong Kong, and become a listed company. Second, you can get approval from the SFC, Securities and Futures Commission. After getting approval from the SFC, you can offer to the public. In fact, collective investment schemes that can be listed on the SEC must be approved by the SFC. That is to say, collective investments and schemes such as real estate investment trusts, exchange-traded funds, etc., must be approved by the SFC before they can be listed. So, if the SFC does not approve, can you sell it? Yes, you can. You can offer to the public who are not in Hong Kong, for example, only to professional investors. Under what circumstances would the SFC approve a collective investment scheme? When it deems appropriate. That is, if the SFC wants to approve the product, it will approve. If it doesn't want to, it can reject the application. It can even withdraw the approval after granting it. In short, it can do as it pleases if it deems it appropriate. Regardless of the situation, the product issuer must first submit an application and find a person to act as the contact person to communicate with the SFC and receive notices and decisions issued by the SFC. So, can anyone, like the lady next door or old man Wang, be this contact person? No. Only persons approved by the SFC can be. The issuer provides an application form to the SFC with details including the contact person's information and contact methods, and the SFC decides whether or not to approve this person as an approved person to act as the contact between the SFC and the issuer. Collective investment schemes that are structured as open-ended fund companies and open-ended fund companies that are offered to the public. A public OFC. Also need to be approved by the SFC, okay? If a collective investment scheme is not authorized, as we just mentioned, it can only be sold to professional investors. Regardless of whether the collective investment scheme is authorized, if the fund manager manages the assets of the collective investment scheme in Hong Kong, because it carries out regulated activities in Hong Kong, it must obtain a license or registration from the SFC, Securities and Futures Commission. But if the fund manager who manages the scheme's assets operates overseas, does it need to obtain a license or registration from the SFC? No, it doesn't, okay? Advertisements for collective investment schemes, as long as they are issued to the public, need to be approved by the SFC. But if it's for professional investors, it doesn't need the approval of the SFC. In addition, besides the Securities and Futures Ordinance, an authorized collective investment scheme must also comply with the provisions of the Code on Unit Trusts and Mutual Funds. CUMF. What is the CUMF? The CUMF is actually part of the Handbook. SFC Handbook for Unit Trusts and Mutual Funds, Investment-Linked Assurance Schemes, and Unlisted Structured Investment Products. The Handbook mainly consists of 4 parts: Overarching Principles Section, CUTMF, the Code on Investment-Linked Assurance Schemes, and the SIP Code, Code on Unlisted Structured Investment Products. The Code on Unit Trusts and Mutual Funds, commonly known as the CUMF, is the basis for the SFC, Securities and Futures Commission, to regulate authorized collective investment schemes. Since collective investment schemes aimed at the public need to be authorized by the SFC, how does the SFC authorize them? For example, what documents should a collective investment scheme submit for authorization? What are the minimum operating requirements and procedures? The basis of the SFC is this CUMF. The CUMF is the foundation for the SFC to regulate authorized collective investment schemes. What are the provisions of the CUTMF, the Code on Unit Trusts and Mutual Funds? Regarding the offering documents of collective investment schemes, the CUTMF stipulates that the following must be clearly stated: investment objectives and restrictions, collateral policy and criteria, policies for valuation of property and redemption pricing, management of liquidity risk, application and redemption procedures, applicable fees and charges, risk warnings/statements, custody arrangements, and circumstances in which the CIS may be terminated. What is a trustee/custodian of a collective investment scheme? A trustee is essentially a custodian. In a collective investment scheme, the decision-making and money-keeping roles are separated. Why is this? To prevent abuse of power. So, in a collective investment scheme, the decision-maker is called the investment manager or fund manager, and the one who keeps your money is called the custodian. Every time the investment manager makes a transaction, or after a transaction, the money or securities used are kept by this custodian, okay? For collective investment schemes established under trust arrangements, such as the custodian of a unit trust is called a trustee. For collective investment schemes established in the form of a company, such as a mutual fund company, the custodian is called a custodian. However, what you need to know is that the trustee fulfills its duties according to the general law of trust and trust contract, while the custodian of a mutual fund company fulfills its duties according to the company's articles, custodian agreement, and management agreement. Therefore, the trustee or custodian itself is not a regulated activity of securities futures. But if you want to act as a trustee or custodian of a collective investment scheme, you must be approved by the SFC, Securities and Futures Commission. What are the regulations to become a trustee of a collective investment scheme? If you want to become a trustee of a collective investment scheme, you must be the following persons, including what? Licensed banks, trust companies registered under the Trustee Ordinance, and are subsidiaries of licensed banks, trust companies registered as trustees of collective investment schemes under the Mandatory Provident Fund Schemes Ordinance, or banks or trust companies recognized by the SFC, Securities and Futures Commission overseas. In addition, the accounts of the trustee/custodian must be independently audited and have sufficient capital, that is, at least 10 million Hong Kong dollars, or equivalent foreign currency. However, if the trustee or custodian is a wholly owned subsidiary of a substantial financial institution, that is, a subsidiary of a large bank, they do not need to comply with these regulations. Okay? Just now we mentioned that in a collective investment scheme, the one making investment decisions and the one keeping the money should be separated. The one making investment decisions is called an investment manager or fund manager, and the one who keeps your money for you is called a custodian. From the perspective of the exam, a fund manager or investment manager is actually equivalent to a management company. It is a legal entity, not a flesh and blood individual. According to the CUTMF, Code on Unit Trusts and Mutual Funds, all authorized collective investment schemes, i.e., collective investment schemes offered to the public in Hong Kong must appoint a management company accepted by the SFC. Does the management company of an authorized collective investment scheme have to be in Hong Kong? No, it can also be overseas. That is, collective investment schemes registered, established, and operated overseas can also apply to the SFC, Securities and Futures Commission, for authorization to be offered to the public in Hong Kong. Does the management company of an unauthorized collective investment scheme need to be accepted by the SFC? Actually, it is not necessary. Why? Because the SFC does not regulate this part, okay? So, what are the conditions for a management company to be accepted by the SFC, Securities and Futures Commission? Yes, there are. In order for a management company to be accepted by the SFC, it must meet several conditions. Let's quickly go over them. 1. What is the main business of the management company? It is fund management. 2. What about the financial aspect? It must have at least 10 million Hong Kong dollars in share capital. 3. If it owes money to the holding company, and this debt is considered as share capital, can it be repaid to the holding company without the SFC's approval? No. 4. It also cannot lend too much money to others. 5. The overall net asset value must always be positive. This is very critical. 6. The people hired, especially those in key positions, must have experience and qualifications, okay? In addition, the management and internal control of the management company cannot be ignored. 1. Directors must have a good repute and sufficient experience. 2. The company's key personnel must have more than 5 years of experience and clear performance. Moreover, the company's human and technical resources must be sufficient, and it cannot overly rely on a certain person. 3. The company must also have internal control, sufficient control measures, and written procedures to handle conflicts of interest and protect the interests of investors. 4. If the company delegates the work of investment management to others, i.e., delegates investment functions, then there must be someone supervising those responsible for investment to ensure that they are competent. However, remember, even if the management company delegates investment functions to others, it still has to bear the primary responsibility, okay? Let's catch up. We're going to talk about a very important aspect, which is the independence of the trustee/custodian and the management company. We've talked before, why is it necessary to separate the people who hold the funds and make investment decisions? Because this can ensure that the investment manager and the custodian check and balance each other and will not abuse their powers. So what does independence mean? Independence means that they maintain clear boundaries in terms of company functions, personnel, decision-making, and finance, with the aim of preventing abuse of power and conflicts of interest. Can the trustee and the management company be in the same group? For example, Kaohsiung Holdings has Kaohsiung Securities, Kaohsiung Trust, and Kaohsiung Management, 3 subsidiary companies. That is to say, Kaohsiung Holdings is the holding company of Kaohsiung Securities, Kaohsiung Trust, and Kaohsiung Management. So if the investment manager of a collective investment scheme is Kaohsiung Management and wants to hire Kaohsiung Trust as the trustee, is it possible? In fact, it is possible. Even if their holding company is Kaohsiung Holdings, as long as Kaohsiung Management does not hold shares in Kaohsiung Trust, and Kaohsiung Trust does not hold shares in Kaohsiung Management, that is, they do not hold shares in each other, they are not subsidiary companies of each other, the directors of Kaohsiung Management and Kaohsiung Trust are different, and the 2 companies have jointly signed a declaration stating that the 2 companies are completely independent. In this case, even if they belong to a holding company, they meet the requirements of independence. In short, remember, the trustee or custodian of a collective investment scheme must maintain independence and separation from the management company, okay? Let's talk about the licensing or registration of the management company again. Remember, a management company of an authorized collective investment scheme, if operating in Hong Kong, must obtain a license or registration from the SFC, Securities and Futures Commission. Usually, a Type 9 license is required, i.e., Type 9 regulated activity providing asset management license or registration. If the management company also acts as a distributor, it also needs to obtain a Type 1 license for dealing in securities, Type 1 regulated activity. However, if the management company operates overseas, is not registered in Hong Kong, does not have a place of business in Hong Kong, or does not carry out any regulated activities in Hong Kong, it does not need a license or registration from the SFC. But these overseas operating management companies still need to be accepted by the SFC, okay? But if the management company operates overseas, is not registered in Hong Kong, does not have a place of business in Hong Kong, or does not conduct any regulated activities in Hong Kong, it does not need a license or registration from the SFC, Securities and Futures Commission. However, these overseas operating management companies still need to be accepted by the SFC, okay? How can an overseas management company be accepted by the SFC? 1. It must be located within a jurisdiction accepted by the SFC. Which ones are there? Australia, France, Germany, Ireland, Luxembourg, Malaysia, Netherlands, Switzerland, Taiwan, Thailand, United Kingdom, and United States. The SFC website lists the jurisdictions. Interested students can check for themselves. 2. If the management company of an authorized collective investment scheme is not registered in Hong Kong, or does not have a place of business in Hong Kong, it must appoint a Hong Kong representative who must be a licensed or registered person, or a registered trust company, for the SFC to accept this management company. Okay, let me ask you, if a collective investment scheme is registered overseas, for example in Ireland, and the fund manager manages the scheme assets in Ireland and offers it to the public in Hong Kong, does the fund manager need to be licensed by the SFC? Does this collective investment scheme need to be authorized by the SFC? The fund manager manages the scheme assets overseas, so the regulated activity is conducted overseas, so no SFC license is needed. However, if it is offered to the public in Hong Kong, this collective scheme must be authorized by the SFC, and the management company must be accepted. If the structure of the collective investment scheme is an OFC, open-ended fund company, it must also comply with the Code on Open-Ended Fund Companies. In addition, public open-ended fund companies must comply with the CUTMF, Code on Unit Trusts and Mutual Funds for authorization, in addition to the OFC Code. All key operators of OFCs, including directors, investment managers, and custodians, must comply with the Handbook. The investment manager of an open-ended fund must have a license for Type 9, providing asset management, regulated activity, and must also comply with the FMCC, Fund Manager Code of Conduct. REITs, real estate investment trusts, are a specific form of collective investment scheme. Its authorization is guided by the Code on REITs. Okay, let's summarize at the end. Collective investment schemes offered to the public must be authorized in accordance with the CUTMF, Code on Unit Trusts and Mutual Funds. So, do the Handbook. CUTMF, Code on Open-Ended Fund Companies, FMCC, Fund Manager Code of Conduct, and Code on Real Estate Investment Trusts related to collective investment schemes that we just talked about have the force of law? No, they don't. Violating these codes is not illegal or criminal, but non-compliance may reflect adversely on the person's fitness and properness and the suitability of the product to remain authorized. Okay, next we introduce structured products. Who defines structured products? It is defined by the Financial Secretary. What are the elements of structured products? First of all, structured products are regulated investment agreements. In addition, the returns, maturity amounts, or settlement methods of structured products are not fixed. They are based on the price or value changes of other financial products, or the occurrence or non-occurrence of specified events. That is, structured products usually reference the rise and fall of other products, the rise and fall of indices, the rise and fall of commodities, or the occurrence or non-occurrence of specified events to define their value. Therefore, structured products are essentially a type of derivative contract. For example, betting on whether a company will go bankrupt, or betting on whether the interest rate will rise or fall in the next year, are usually such. Under what circumstances can structured products be offered and marketed to the public? Like collective investment schemes, there are two ways, either listing on the SEC, Stock Exchange of Hong Kong, or being authorized by the SFC, Securities and Futures Commission. However, structured products listed on the SEC, such as derivative warrants, bull-bear certificates, and inline certificates, must be approved by the SFC before they can be listed. How is it recognized? Just like collective investment schemes, the issuer of structured products needs to submit an application to the SFC, Securities and Futures Commission. At the same time, they need to find a person to act as a contact person, specifically to receive notifications and decisions issued by the SFC, and this person needs to be approved by the SFC. The SFC grants approval under circumstances it deems appropriate. Of course, it also has the right to refuse approval or even cancel the approval after it has been granted, okay? If the SFC refuses to approve the structured product or refuses to approve the issuer's contact person as an approved person, it will provide reasons. For example, if the SFC believes that the structured product is not in the interest of the investing public, it can refuse to approve it. One thing to remember is that not all structured products are securities. Only those that are open to the public and approved by the SFC are considered securities. Just like collective investment schemes, advertisements for structured products need to be approved by the SFC if they are issued to the public. But if they are for professional investors, they do not need the approval of the SFC, okay? In addition to the SFO, Securities and Futures Ordinance, listed structured products also need to comply with the listing rules. If they are non-listed structured products, they need to comply with the SIP Code on Unlisted Structured Investment Products. What are the regulations in the SIP Code on Unlisted Structured Investment Products? It stipulates some qualifications related to persons involved in unlisted structured investment products. What are they? For example, as we just mentioned, the issuer of structured products needs to find a person as a contact person to receive notifications and decisions issued by the SFC, Securities and Futures Commission. This person needs to be approved by the SFC. The SIP Code first puts forward some special regulations for this approved person who specifically communicates with the SFC. That is, the approved person needs to be approved by the SFC and must meet some conditions. What conditions? First, he must be a director of the issuer or a guarantor. Second, he must hold a Type 1 or Type 4 license or registration from the SFC. Third, he must reside in Hong Kong, okay? The SIP Code on Unlisted Structured Investment Products has some special regulations for the issuers of authorized unlisted structured investment products. First of all, these issuers are corporations, and they must be established in Hong Kong or other places recognized by the SFC. In addition, one of the following two categories of qualification regulations must be met. The first category is one of the following institutions with a net asset value of at least 2 billion Hong Kong dollars. A. Banks regulated by the HKMA, Hong Kong Monetary Authority. B. Corporations licensed by the SFC, Securities and Futures Commission. C. Overseas banks accepted by the SFC. D. One of the top 3 credit ratings given by an internationally renowned rating agency. The second category requires: A. For non-collateralized structured investment products, the issuer must have a guarantor to provide a full guarantee, or B. For issuers that are SPV, special purpose vehicles, the structured investment product must be fully collateralized. What is a special purpose vehicle? Simply put, it is a company established for a specific purpose, usually registered in some offshore areas, because the laws there are more relaxed and there are tax benefits. In short, the issuer must either have enough money, a license, and a high credit rating, or have sufficient guarantee or collateral to meet the SFC's qualification requirements. Also, the issuer must maintain independence from the trustee/custodian or the key product counterparty, okay? For authorized unlisted structured investment products with guarantees, there must be a guarantor. What are the requirements for the qualifications of the guarantor in the SIP Code? Code on Unlisted Structured Investment Products. The requirements are the same as the qualifications of the first type of issuer. The guarantor must also have a net asset of at least 2 billion Hong Kong dollars, or a recognized domestic or foreign bank, a licensed corporation, or a very high international credit rating. What does the guarantor do? It's a guarantor. If the issuer cannot fulfill its obligations to investors, these obligations must be borne by the guarantor, okay? And it's unconditional and irrevocable. If the issuer is a special purpose vehicle or is not a bank or licensed corporation recognized by the HKMA, then a product arranger must be designated for an unlisted structured investment product to be approved by the SFC, Securities and Futures Commission. This product arranger must hold a Type 1, dealing in securities, license or registration, and have no violation record. So is this product arranger the only one? No. The issuer can appoint multiple product arrangers, but must designate one of them to communicate with the SFC, Securities and Futures Commission. Like the issuer, the product arranger must be independent of the trustee/custodian or any key product counterparty. What is the main responsibility of this product arranger? Their primary responsibility is to ensure compliance with the provisions of the handbook. That is, to ensure compliance. They also need to maintain appropriate systems, controls, policies, and procedures for risk management, product valuation, collateral valuation, and administrative affairs. At the same time, they also need to provide information and undertakings to the SFC. In other words, the product issuer must ensure that the issuer's unlisted structured investment products and daily operations comply with the SFC's compliant requirements. However, the product arranger does not need to bear legal responsibility for the financial obligations of the issuer or guarantor. For assets of collateralized unlisted structured investment products, they must be held by an independent trustee/custodian, that is, the person making investment decisions and the person holding the assets must be separated. A qualified trustee/custodian also needs to meet the following conditions. 1. One of the following institutions, a licensed bank, or a trust company affiliated with a licensed bank, or an overseas banking institution accepted by the SFC. 2. The share capital has been independently audited and is at least 10 million Hong Kong dollars. And 3. Maintain independence, independent of the issuer, any guarantor, product arranger, and key product counterparty. What exactly is a key product counterparty, which has been mentioned so many times before? Let's explain with an example. For instance, there is a structured investment product called ABC Company Linked Bond, and its return is based on the swap agreement of ABC Company. If the swap agreement is favorable to ABC Company, the investor makes money. If it's unfavorable, the investor may suffer losses. In this case, the investor's return mainly depends on the performance of ABC Company, which is a counterparty, and this counterparty is the key product counterparty. That is to say, ABC Company is the key product counterparty of the ABC Company Linked Bond. Note that the SIP Code, Code on Unlisted Structured Investment Products, has 3 important provisions for the key product counterparty. 1. Independence. The issuer, guarantor, and trustee/custodian must maintain independence from the key product counterparty. 2. Selection method. The issuer and product arranger should consider the counterparty's risk management and creditworthiness and select the key product counterparty in an objective manner. 3. Trading principles. Transactions with the key product counterparty should be based on fair market value and the best available terms. The SIP Code, Code on Unlisted Structured Investment Products, not only stipulates the qualifications of issuers, guarantors, and product arrangers, but also requires the product structure, offering documents, and advertisements of unlisted structured investment products to comply with the provisions stipulated in the SIP Code. Moreover, the issuer also needs to provide a Cooling off period to investors, carry out post-sale continuing obligations, including disclosures to investors and market making. In summary, remember, unlisted structured investment products sold to the public must be approved by the SFC, Securities and Futures Commission, and comply with the provisions of the SIP Code. As we mentioned before, the CUTMF, Code on Unit Trusts and Mutual Funds, and the SIP Code, Code on Unlisted Structured Investment Products are actually part of the Handbook. The Handbook mainly includes the Overarching Principles section, CUTMF, Code on Investment-Linked Assurance Schemes, and the SIP Code. It mainly provides guidelines for the authorization of unit trusts and mutual funds, investment-linked assurance schemes, and unlisted structured investment products. We have already introduced the CUMF and the SIP Code. Now let's introduce the provisions of the Overarching Principles section. What are the regulations for product providers? The Overarching Principles section stipulate that product providers must comply with the following 7 general principles. General Principle 1, act honestly, fairly, and professionally. General Principle 2, disclosures must be complete and accurate. General Principle 3, proper protection of client assets. General Principle 4, avoid conflicts of interest. General Principle 5, applicable legal and regulatory requirements must be complied with. General Principle 6, shall discharge their functions with due skill, care, and diligence. General Principle 7, advertisements for a product shall be clear, fair, and present a balanced picture with adequate and prominent risk disclosures. So who is the product provider? If it is a collective investment scheme, it refers to the management company of the collective investment scheme, the collective investment scheme itself, and its board of directors. If it is a structured product, it refers to the issuer. The Overarching Principles section also clearly stipulate the disclosure requirements for offering documents and product, KFS, key fact statements. Offering documents should provide complete information needed by investors to help them make informed decisions. The product KFS should be brief, not exceeding 4 pages, clear, concise, and effectively summarizing the product's information, allowing investors to understand the product's features and risks. The cover page should have a warning statement reminding investors not to make decisions based solely on the product KFS. We just mentioned that advertisements for collective investment schemes and structured products require approval from the SFC, Securities and Futures Commission. In fact, remember that all advertisements for investment products offered to the public require SFC approval, unless there are exemptions, okay? Violating this provision is an offense and could potentially lead to imprisonment. So, are there any situations or documents that can be exempted? Yes. Publicly listed prospectuses and listing documents do not need to be approved. Advertisements by intermediaries on securities, futures contracts, and corporate finance, that is, if an intermediary recommends you to buy stocks from them, do not need SFC approval, okay? Products that only serve professional investors, that is, advertisements targeting professional investors, do not need SFC approval. In the course of daily operations, newspapers, publishers, conduits, and media that publish such advertisements can be exempted from responsibility. So how does the SFC, Securities and Futures Commission, approve advertisements? Similar to the approval of collective investment schemes, if you issue advertisements for investment products to the public, you must submit an application to the SFC. You need to have an advertisement contact person approved by the SFC, who is specifically responsible for receiving notifications from the SFC. The SFC will grant approval under any conditions it deems appropriate, okay? If the advertisement of an investment product contains false, misleading, or deceptive information, causing investors to make wrong decisions and suffer financial losses, then what? There are mainly 3 types of misrepresentations in advertisements. One is called negligence, one is called fraud, and the other is called recklessness. Negligence is mainly unintentional. It may be caused by carelessness or not taking enough precautions to ensure the accuracy of the advertisement content. The most serious consequence of this situation is mainly civil remedies, such as compensation, injunctions, etc., which are civil, okay. If it is intentional, it is fraud or recklessness. These two situations are more serious and may lead to criminal liability, not only fines, but also possible imprisonment. Moreover, after the government initiates criminal prosecution, the damaged party can also bring a civil lawsuit against the party who issued the fraudulent or reckless statement, asking for compensation for the loss, okay? And civil lawsuits can be filed at any time, okay? Please note that this provision on false statements applies not only to intermediaries, but to everyone. Even if you don't have a license or registration, as long as you issue false, misleading or deceptive statements about securities and futures investment products, and intentionally induce others to buy these products, it is considered a false statement. But if you just describe it and have no intention to induce purchase, it does not violate the Securities and Futures Ordinance, okay? For example, journalists, they do not need a license or registration to publicly issue investment advice. But if they make false or misleading statements, the SFC can also prosecute these journalists. Do you understand? Please note that the provision of false statements applies not only to intermediaries, but to everyone. Even if you don't have a license or registration, if you make false, misleading or deceptive statements about securities and futures investment products, and intend to induce others to buy these products, it is considered a false statement. But if you are just describing and have no intention of inducing others to buy, then it does not violate the Securities and Futures Ordinance, okay? For example, journalists, they do not need a license or registration to publicly give investment advice. But if they make false or misleading statements, the SFC can still prosecute these journalists, all right? Next, let's review the content we learned in the first chapter, the difference between the MPF, Mandatory Provident Fund Scheme, and its constituent funds. What is the difference between the Mandatory Provident Fund Scheme and the Mandatory Provident Fund constituent funds? The Mandatory Provident Fund Scheme is the plan you are currently contributing to, such as the China Life MPF Master Trust Scheme in the example in the picture, while the Mandatory Provident Fund constituent funds are the various funds under this Mandatory Provident Fund Scheme, such as China Life MPF Conservative Fund, Guaranteed Return Fund, Balanced Fund, Growth Fund, Hong Kong Equity Fund, etc. If you contribute to this MPF scheme, you can choose your preferred MPF constituent funds to invest your contributions in, such as Balanced Fund, Growth Fund, etc., okay? The MPFA, Mandatory Provident Fund Schemes Authority, is the main regulatory body of the Mandatory Provident Fund system, responsible for the overall management and implementation of the system. The Code on MPF Investment Funds and the Code on Disclosure for MPF Investment Funds are both issued by the MPFA. Mandatory Provident Fund schemes are also registered and regulated by the MPFA. So what is the connection between the SFC, Securities and Futures Commission, and the MPFA, Mandatory Provident Fund Schemes Authority? Remember, the SFC is only responsible for one thing, which is approval. It approves MPF schemes, as well as their offering documents and marketing materials, okay? Why does the SFC need to approve MPF schemes? Although MPF schemes are designed for retirement, their nature and that of their constituent funds are similar to other financial investment products. Since they are investment products, they naturally need to be approved by the SFC. However, before approval, these materials must be reviewed by the MPFA. The registration of MPF schemes, the approval of constituent funds, and subsequent regulation and education of MPF schemes are all done by the MPFA, and the SFC does not deal with these matters. In addition, the investment managers of MPF scheme products conduct investment activities in Hong Kong, so they must obtain a license or registration from the SFC and be approved, okay? The requirements for the approval of MPF schemes, the appointment of investment managers, etc., are clearly stated in the SFC Code on MPF Products. Issued by the SFC. With constant reforms in the financial market, many startups have started to explore crowdfunding or initial coin offerings to raise funds, both of which involve the application of fintech. Crowdfunding should be familiar to everyone. I believe you all have received various donation requests. So what is crowdfunding? Unlike the traditional method of using a donation box, the crowdfunding we are talking about here uses online platforms to connect small businesses or individual projects that need capital with a wide range of investors or supporters. These platforms allow entrepreneurs, artists, inventors, etc. to showcase their ideas, plans, or products while detailing their funding needs and uses. At the same time, investors or supporters can browse these projects and choose whether or not to invest in them based on their own interests and evaluations. Compared to traditional bank loans or venture capital, crowdfunding lowers the threshold for financing, allowing small businesses and individuals who may not have sufficient credit, history, or collateral to obtain funds. However, with traditional financing methods, businesses usually need to provide detailed financial statements, business plans, and market analysis to prove their debt repayment ability. Banks and venture capitalists also conduct in-depth due diligence on businesses to ensure the safety of funds. Compared to traditional financing, projects on crowdfunding platforms may not have undergone in-depth investigation, so the risks that investors have to bear may be greater. There are many types of crowdfunding, such as donations that we just mentioned. Here we mainly introduce two types. One is called ECF, equity crowdfunding, and the other is P2P, peer-to-peer lending, which has been constantly making headlines in the past 2 years. Equity crowdfunding is where investors gain equity in a company through investment. Simply put, investors give money to the company, and in return, they get shares or stocks of the company. Peer-to-peer lending is of a loan nature. That is, investors lend money to the company, not buying its shares. ECF, equity crowdfunding, and P2P, peer-to-peer lending have attracted regulatory attention because they may involve securities offerings and may constitute collective investment schemes. For example, equity crowdfunding may involve the QMPO companies, winding up and miscellaneous provisions, ordinance, and equity crowdfunding and peer-to-peer lending may involve the restrictions on advertising for public offering of securities under the SFO, Securities and Futures Ordinance. In addition, the activities of promoting equity crowdfunding and peer-to-peer lending may constitute regulated activities that require a license, such as Type 1 regulated activity, securities trading. A digital token is a digitally written entry on a computer code that is able to be controlled by one or more persons in accordance with the set of functions the computer code provides or permits. Since the creation of the first batch of bitcoins in 2009, various digital coins have been widely issued through blockchain or distributed ledger technology. Investments in digital coins have reached billions of dollars, often occurring in environments without traditional market regulatory mechanisms, posing risks to investors and challenges to regulatory authorities. Whether they are called cryptocurrencies, crypto assets, or whatever, the SFC defines digital tokens that comprise a representation of value as virtual assets. Most investments in virtual assets are conducted through ICOs, initial coin offerings, and STOs, securities token offerings. ICOs and STOs may be considered as securities because they have characteristics of securities, such as tokens represent equity or rights in a company, i.e. shares. Tokens represent debt, i.e. debentures. The returns of the tokens are collectively managed for profit, constituting a collective investment scheme. What are the differences between ICOs, initial coin offerings, and crowdfunding? ICOs usually involve startups, which seek large amounts of capital through the internet, somewhat similar to crowdfunding. Unlike equity crowdfunding and P2P network loans, ICOs are done by selling virtual assets in exchange for fiat currency or some form of cryptocurrency. Depending on the rights generated by the ICO, the token may be considered as securities or a collective investment scheme. Okay, let's talk about the handling of virtual asset regulation. First of all, talking about virtual assets, if these assets meet the definition of the SFO, Securities and Futures Ordinance, they are within the management scope of the SFC, Securities and Futures Commission, okay? But if they do not meet this definition, we will see if the related activities of these assets involve the execution of regulated activities under the SFO. In addition, if the structure of the investment portfolio is a CIS, collective investment scheme, even if they only contain virtual assets that are not securities or futures contracts, their related activities must comply with the provisions of the SFO, all right? The trading of cryptocurrency, such as Bitcoin and Ethereum, futures contracts and providing advice on these futures contracts are Type 2 regulated activities and Type 5 regulated activities. Now let's talk about cryptocurrency exchanges, which are platforms for buying and selling different types of virtual assets. The operation of these platforms, what licenses they need, mainly depends on whether the virtual assets they trade meet the definition of securities. If they do, the platform needs to be licensed or registered in accordance with the SFO, Securities and Futures Ordinance. If they do not, they need to be licensed in accordance with the AMLO, Anti-Money Laundering and Counter-Terrorist Financing Ordinance. In short, under the dual licensing system, these platforms for buying and selling virtual assets must obtain a license before they can operate, understand? Cryptocurrency exchanges that comply with the SFC, Securities and Futures Commission's licensing regulations will be licensed to conduct Type 1 and Type 7 regulated activities. If intermediaries want to provide virtual asset dealing services, they need to follow the following procedures. 1. They can only provide virtual asset dealing services to existing customers who are related to Type 1 regulated activity and are professional investors. 2. They can only cooperate with cryptocurrency exchanges licensed by the SFC, Securities and Futures Commission. 3. Even if the intermediary services extend to non-securities virtual assets, they are still subject to the regulation of the SFC, okay? 4. If intermediaries consider providing services involving virtual assets, they need to note that this will be considered a significant business change and they need to notify the SFC in accordance with the Securities and Futures, Licensing and Registration, Information, Rules. Investing involves risks. Be cautious when entering the market. The risks of virtual assets can be higher than the stock market, and the SFC, Securities and Futures Commission, has listed a lot of them. Let's see what risks there are. Did you know that tokens usually lack the support of physical assets or government guarantees, so prices often fluctuate due to short-term speculation and small-scale capital flows? In terms of accounting, there is actually no clear standard to determine the value. This is a big problem, isn't it? Everyone has heard of network security issues, and hundreds of millions of funds have been stolen by hackers. The virtual asset market actually has little regulation. This may lead to some irregular operations, you understand. Because these virtual assets are usually anonymous, there is a risk of being used for money laundering and financing terrorism. Isn't it serious? Companies that provide trading platforms may have multiple capacities, which may lead to conflicts of interest between them. Regarding virtual assets, in fact, a lot of information is not transparent enough. This increases the risk of being defrauded, all right? Finally, did you know that not all virtual assets are protected by the same laws, especially assets traded in specific markets? Therefore, investing in this field requires special caution. Do you understand these risks? Are you preparing for HKSI, LE, MPFE, IIQE, EAQE, or SQE examinations? Look no further. At 2C Exam, we have everything you need to succeed. Our comprehensive suite of products and services includes premium online and offline question banks, personalized one-on-one tutorial sessions, tailored group classes, and private consultation sessions. Need assistance with licensing or examination inquiries? Don't hesitate to get in touch with our knowledgeable team. We're always here to help. We're open Monday to Friday, from 9 a.m. to 12 p.m. and 1 p.m. to 6 p.m. You can reach us by phone at 211-09644 or send us a message on WhatsApp at 934-72064. Need to send us a fax? Our fax number is 211-19644. Prefer email? Drop us a line at info@Exam.com. And don't forget to connect with us on WeChat, HK2C Exam. Choose 2C Exam, your path to exam success. Reach out to us today and let us help you achieve your goals.